Hi, everybody. Great to be with you again. I love this Aspen Ideas Festival. Keith, it's nice to see you again.
It's always good to see you, Maria.
Yeah, I thought we would start. I mean, the title of this talk is Hidden Opportunities and Risks for Your Wealth. So I'm going to start asking Keith, who is overseeing an enormous portfolio. U.S. Trust has $300 billion in assets, $250 billion assets under management, the whole portfolio, more than $300 billion. So we're talking about an enormous amount of money where he is directing in terms of volatile markets and long-term investing. So, Keith, here's what the Dow has done in the last, I'll give you a few days here. Last Tuesday, down 117. Wednesday, down 127. Thursday, up 181. Friday, down 106. Monday, up 110. Tuesday, up 138. Wednesday, down 206. Volatility, huge moves up and down. Very tough to say really what's going on. So can you characterize what that is, why we are seeing such huge moves and volatility in the stock market?
What you described is partly why my hair is graying. So unfortunately, that's been kind of the way of the world over certainly the more recent period, but even longer than that. There's a couple things I think that are driving that, Maria. Number one, I refer to it as the data point du jour issue, and that is people are desperately trying to find a trend line in something, be it good or bad. And so what they tend to do is they overreact to the immediate data point, whether it's a good or bad. If it's good, the markets rally. If it's bad, the opposite. You know, and obviously that's a bad way to go. And we're gonna continue to see that until there's a clearer trend in the broader macro data. So that's number one, and that just by definition creates volatility. But the second thing, we had what a lot of people perceived as a pretty big change, and that was from Chairman Bernanke and the minutes of the FOMC talking about the fact that if unemployment were to get down to 7%, and there's a belief that we could see that level somewhere around the midpoint of 2014, there could be the beginning of an end to the quantitative easing. So number one, that was a change from 6.5. Originally, they said if it got down to 6.5, they would begin a process. So I think when that information came out, which was new information, the reaction, especially among momentum players and what I call fast money, the hedge fund type investors, it was a sell now, ask questions later, and a bit of an overreaction to it. Because what's interesting, Maria, I think people really misunderstand what it's going to look like when, in fact, the Fed does begin the process of unwinding this quantitative easing, meaning that a lot of people believe it's an on-off switch. They're going to go from this massive, $85 billion a month of bond purchases, expanding the Fed's balance sheet by $1 trillion a year, to all of a sudden, off, done, we're tight. And
that's not what they're going to do.
That's not what they're going to do. It's a process. And they're going to go from, when the process begins, it's going to go from that to what we call quantitative deceleration first, meaning they'll simply go from $85 billion a month to some lower number.
So maybe $65 billion or...
Yeah, and the point being, when they do that, they're still expanding the balance sheet, they're still providing tremendous liquidity, but at a slower rate. So that's step one.
And they're not going to raise rates necessarily.
No, that's the end of the process. The second step is what we call quantitative maintenance. And think about it when you're in an airplane. If the pilot gets up to cruising altitude, but then if there's some turbulence, they'll go down or they'll go up based upon the turbulence. Well, that's what the Fed will do. They'll go down to 65, 50, whatever the number is, and then they'll wait for more data to come in. And based upon that data, they'll either add more liquidity or maybe take some more out. That's the second step. Then you get into the quantitative shrinking, where they actually begin to shrink the balance sheet by letting a lot of the bonds they hold roll off on maturity. And then you get to true quantitative tightening, where you're actively shrinking the balance sheet, and then you get to actually rates beginning to rise in the form of the Fed funds rate. So and this process could take 18 to 24 months.
So given the fact that we are seeing an overreaction, you said that the market is overreacting, are you advising folks to stay in the stock market, stay invested in stocks for the long term, even though the Fed will start changing its strategy when employment improves?
Yes, we went overweight equities with respect to the advice we were giving our clients back in the fourth quarter, actually November of 2012.
So you rode this whole rally back from November.
Yeah, we had been neutral on equities, although quite frankly, a lot of our clients were not even at that level because there is still so much skepticism and fear about the equity markets. But we had said in November when the fears really hit a crescendo with the words about the election, the fiscal cliff, Europe, all kinds of things were getting investors nervous. And the market, if you remember, really sold off. And at that point we said that it was a perfect time to go overweight equities. We had a target for this year in the S&P of 1,600 based upon the expectation of earnings in the S&P this year of $108. So what we've been telling clients, it's not going to be a straight line. You will see periods of brief corrections. We thought anywhere from 3 to 5%, and I think the correction we just saw was around 4%. It had peaked at about 1660 on the S&P. But what we're telling clients is use those opportunities, because we think they are opportunities, to begin to move money into equities. Because we think, Maria, that we're at the beginning of a secular bull market that can run certainly over the next 3 years, with an S&P in 2015 hitting somewhere around 1950, maybe even 2000, which is a nice increment from roughly 1600 today.
I love the idea of a secular market because there are certain characteristics of a secular bull market that you could actually look and say, okay, are we at stage 1 yet? Are we at stage 2? So I'm gonna get back to that. But this Friday, the end of the first half of the year happens, right? The end of the second quarter happens on Friday. What's your expectation for the economy and the markets second half of the year?
We're expecting to see a gradual pickup in economic activity, both in the U.S. as well as globally. So, and that's part of the underpinning that we see for why we think this is a secular bull market and we're not at the tail end of just a cyclical move. We think that there's a very solid underpinning right now in both the U.S. economy as well as the global economy. So if the U.S. is somewhere around 2% real growth this year, we would expect that over the next couple of years to move upwards toward 3% or maybe somewhat higher. And globally, which is as important given how important the global markets are to especially the big U.S. Multinational companies, we think global growth can go from 3% currently up approaching 4% again as we go the rest of this year into next year and beyond.
For a long time, and even last year here at the festival, we talked a lot about the growth of the emerging markets and how this was the spot in the world that American multinational companies were going to be exposed to and gaining great growth. And in fact, in the last, how long has it been now? Almost 8 months or so, 6 months certainly, we're seeing heavy outflows from the emerging markets. You see these protesters going on in Brazil. For a while, Mexico was hot as hell, and now money's coming out of Mexico. What's the problem with the emerging markets right now?
I think the emerging markets, I think of as the tail of the whip. So when you really believe that things have come together the way they need to, that's where the real leverage play is, because there's volatility, there's uncertainty. I think part of the issue for the emerging markets in general has been China. There's a lot of issues around China. Growth has decelerated. That was by design by the government because growth had gotten too frothy, and with that, concerns about inflation, et cetera. So we're now, the great debate is, will China grow at 7.5%, 7%, what is it? So China kind of drives, I think, the tenor of the whole emerging market. And as you said, I mean, we've seen some issues specific to other countries, and I just think all that makes people nervous. I believe when people get more convinced that the global trends will be what I described, that we are on a sustained move and it will be an accelerating growth rate globally, then I think more people will begin to move into the emerging markets as an investment because, to your point, that's where it's a three-speed world, right? The U.S. right now, 2% on its way to 3%. Europe, 0, maybe negative, probably mired for quite some time in that 0 to 1%. Hopefully we'll see more aggressive monetary policy coming out of the monetary authorities there, but clearly subpar for quite some time. And then the third are the emerging markets, which will be probably more like a 5 to 6% aggregate growth rate.
I want to get back to the emerging markets and certainly China because I know it's important for the global economy. But let's stay in the U.S. for a moment because that really has been the focus of investors. It feels like people are coming back to the U.S. fleeing places like emerging markets. Where is the growth in the U.S. right now? We're looking at a 2% grower overall, but there are other areas, sectors that are growing much faster than that, right? We want to find these hidden opportunities.
Well, one of the things that people need to understand, even within the U.S., you've got the public sector and the private sector both get aggregated, so the GDP number we all see takes into account both. The private sector is actually doing quite well. You're seeing the private sector grow probably in the 3.5% range right now, ish.
And corporates are sitting on an enormous amount of cash.
Corporates are sitting on tremendous cash. The problem has been the public sector is in contraction mode, growing probably 1.5%, if that. So when you combine it, because it's an aggregated number, you get this very anemic-looking 2% level, but I think it gives a misleading view, and that's why people have been surprised by earnings, because they see 2%, right away think, well, how good can earnings be in a, quote, 2% growth environment? But in reality, what the companies are experiencing is not only more like a 3.5%, which equates to the private portion, but they're benefiting from that global growth, which is even faster. So that's why you're seeing companies, the S&P will be at record earnings again this year if it comes in around $108, which we do think it will. And you make a great point. I mean, the part of why we're bullish on the U.S. market, there's a host of reasons. One is the economic underpinning. That's going to create the tailwind you need and drive earnings. Number two is the fact that you've got companies sitting right now at the end of 2012 with $1.45 trillion of cash on their balance sheets, and they're generating cash like crazy because they're incredibly streamlined. They've taken a ton of costs out of their cost structure, and so they're generating, with the profits they're now seeing. With that comes a lot of free cash flow. With the 1.45 trillion, we think is going to be used, and it's already happening, to raise dividends, to buy back stock. It's going to ultimately go into capital spending, which will support the economy as well as hiring. And the last thing is, we expect to see a real tick up that will be sustained in M&A activity. Because what's happening is that the revenues that companies are seeing are not where they want them to be. So even though the bottom line is strong, the top line is still a bit subpar. And a lot of CEOs are now concluding they've got to go inorganic. They have to go out and buy other companies to get the top line growth that they're looking for. And if you think about buying back stock and M&A, you're shrinking the supply of equities just at a point we think the demand for equities will be going up as people get more conviction.
See, I would have expected more deal flow given the level of interest rates. I mean, we're going to look back one day and we're going to say, wow, remember when we could have borrowed at 3%? Remember when we could have done this at 2%? And you're not really seeing the kind of M&A that one would expect. So is that a confidence issue? Even though they're sitting on all this cash, are CEOs still uncertain and unwilling to put that money to work beyond dividends and buybacks?
I think it's a good point. I think you're right. I think there's still uncertainty. There's still uncertainty with respect to tax policy, the regulatory issues. In some industries, companies are still waiting for regulations to play out.
Like Dodd-Frank.
Like Dodd-Frank, exactly. So I think that is holding CEOs back, the pace of it, because you're right, you would expect it to have already begun in greater amounts. But we think the pipelines are there, and now the question is just getting it from the 2-yard line into the end zone. And I think once it starts, it's going to accelerate, because then other CEOs are going to start to think, people are moving. I don't want to get behind the curve on this.
So where do you want to be exposed then if you are looking for growth in a 2% environment? I mean, technology has changed the game in a number of industries. Healthcare, for example. Right. I mean, I'm seeing so many exciting things happen as a result of technology there. But where would be the sectors that you would advise clients, look, here's where you want to be exposed to because that's where the growth is? The dividend payers were working for a while, right. But then people were saying, well, maybe I don't want to stay with the dividend payers and instead go with the cyclical, the companies that are sensitive to the economy. What's your take?
Well, what's interesting was, and this is partly why we're also still very bullish, a lot of people say, well, look how far the market's moved. Before we had the correction, it had run 17%. Well, we found that was too far, too fast, and we got that little pullback. But what's interesting is, during that whole rise, the sectors that drove it were the defensive sectors. People didn't go in saying, hey, the economy's good, earnings are good. They're saying, I want to get in equities, but I'm going to get in the high dividend paying companies, which tend to be the utilities, consumer staple, things like that. So the interesting thing is that a lot of the initial run in the market the first half of the year was driven by more defensive in nature companies. The other thing that was interesting to me was we have seen very little, some cash has begun to move into equities, Maria, but very little. There's still a ton of cash sitting on people's personal balance sheets. And the other thing people keep waiting for is what they call it the great shift, which is the move, all the flows that have gone into the bond mutual funds. So over the last 5 years, $1.1 trillion have flowed into fixed income mutual funds. And at the same time, $500 billion have flowed out of equity mutual funds. That process has not begun at all. In the first quarter, you had positive flows finally in equities, but you had positive flows still in fixed income. So a lot of cash, a lot of the process of unwinding fixed income and moving that to equity, not even begun, and the beginning of the rally first half of the year defensive. We think as you go forward, as people do get more confidence in the economy here and globally, and they look at the relative values, people are going to increasingly say we need to have more of a pro-cyclical bent to the portfolio. That's what we've been recommending. So to that point, we do like technology, immense driver of so many things, and that's another important thing about the U.S. We're at the forefront of that. So our companies and industries are benefiting from that, often through greater efficiencies, higher productivity, lower costs of doing what they do. We like technology, we like industrials. Again, companies and industries exposed to both accelerating growth here, but very importantly, accelerating growth globally.
Well, I'm glad you mentioned the folks that have all this money in cash. This is really a major trend, and that's what leads me to believe that you could see that potential great rotation that you're talking about, money out of fixed income going into stocks. I was talking to a number of overseers of assets recently, and they said 30% of their clients are sitting in cash. Right. Is that the same for you? A full 30% have their money in instruments like money markets, cash accounts, savings accounts, where they're getting no yield?
We aren't that high. I'd say if we were to look at our clients in aggregate, and it really runs the gamut, and in some cases it makes sense to have greater liquidity, but I'd say on average, maybe clients have about 10% of their assets in cash in U.S. Trust. But we did an interesting survey. It's called our Wealth and Worth Survey. We do it annually. And we survey non-U.S. Trust clients, so wealthy and ultra-wealthy individuals, but non-U.S. Trust clients. We know what they're doing, but we want to figure out, is there something going on out there that we need to be aware of? And what was interesting, and exactly to your point, Maria, so the respondents said, number one, we're extremely optimistic. We've kind of weathered the storm the last 3 or 4 years. We've focused on wealth preservation, return of investment, not return on investment. So kind of Yahoo, we survived. And 88% say they're extremely optimistic about their financial situation today, and 70% said they're extremely optimistic about the future. Those are huge numbers.
Yeah.
But then, and here's the disconnect, when we talked about, so talk about your investment portfolio and what are you doing, 56% of those same respondents, this optimistic bunch of individuals, said that they are holding significant amounts of cash, and only 16% said that they had any immediate plans to invest that money. So there's people are kind of mentally feeling better, but they're still not translating it. It's consistent with what you heard. Little less true of our clients, but I will say, even if they're not that much in cash, they're not yet where we'd like them to be from an exposure to equity standpoint.
And part of it is that the 2008 financial collapse hurt. And it burned so many people that they're afraid to actually put the money with. I have to say, I have money in savings accounts and money market accounts. How many people in the audience have as much money in cash accounts, that's savings, money markets, et cetera, as they would in the stock market? How many people in the audience have money in the market? Wow, this is, okay, so this is more like your audience. Here, yeah. This is actually your clientele, U.S. Trust.
I see some of them out there, yeah.
Because they are invested, they are invested in the market. What do you think it's going to take to get people to recognize that if you've got money in cash, you're actually losing money when you put in inflation there? You need to be in stocks for the long term. How do you get that to translate?
Yeah, that's a great question. I think there's going to be two things that are going to go on. With respect to cash, people are going to realize the math isn't working. I don't care what age you are, as you think about whatever it is you are hoping to achieve, whatever it is you want to be doing out in the future, people are going to realize that when you earn basically no return, and you compound no return, it's still no return.
That's why
So,
$40 billion came out of bond funds in June.
Yeah, yeah. So
They,
I think
they got their statements. They said, oh, God, I've lost money.
well, that's the other interesting thing. So I think from the pure cash side of it, it's going to be just the realization that there's no math, there's no compounding. And then all of a sudden you go out in the out years, you're not going to be where you need to be. Fixed income is really interesting. So number one, people have been earning a negative real return on in most fixed income classes are generating negative real returns, meaning the return that the investor is getting is below the rate of inflation. Now, maybe people understand that, maybe they don't. That's reality. So your wealth is actually deteriorating, whether it feels that way or not. But what we worry about, we still think the asset class with the greatest risk, as we look out over the next couple of years, back to the Fed ultimately moving down this path of unwinding the quantitative easing, is that people will have forgotten, I think, you can lose money, real money, not just, not relative to inflation, but actually see your accounts go down. And I think as rates ultimately begin to move, or the prospects of rates moving up, and as a result, bond prices moving down, people are going to have that moment of, I gotta move. So my hope is that people understand that early enough, so it's not this that 1.1 trillion is all running to the exit at the same time, because then you kind of complete the picture. But I think, again, it has to happen. I believe it will begin to happen, and again, that's good news for the equity markets.
I love the story of retirement today, because today when we all approach retirement age, we're not saying, oh, I want to quit my job and go head for the hammock. Right. We want to do something new. We want to do something and engage in something. And that's why it's increasingly important to have the money to be able to do that. What are you hearing from your high-end clients with money in the market as they look toward retirement? How are they approaching that in terms of their own financial management?
Well, it's a very interesting question, because there's two aspects to that. Number one, it's the point you just made. People don't use the word retirement anymore. When I talk to, whether they're friends, whether they're colleagues, whether they're clients, people talk about the next phase, the next challenge, the next leg of the journey. They don't say the next, and the hammock is not part of that. So people are clearly want to stay engaged. You think about the baby boomers. They've grown up working 12 hours a day, 6 days a week. It's who they are, it's what they do.
They're not going to turn that off.
They're not going to turn. That's a DNA thing.
Right.
It doesn't. There's no switch, right? You look for it, but it's not there. So number one, there's a very different mindset. So some people maybe they'll stop doing what they're doing now. Some are going to start new businesses. A lot are going to go into nonprofit, but they're going to do stuff. That's number one. Number two, there was an interesting thing. The survey we did last year, again, non-U.S. trust clients, a big percentage, over 50%, said that they did not consider leaving money to their children as a high priority. And people were shocked by that, like, oh my God, right?
I didn't hear that. That's interesting.
And people said to us, well, what do you make of that? And I said, the question was, are they that negative on their children or heirs? And I said, could be, but it's more than that. I said, they're not thinking that way. Again, think of someone in their early 50s. They're going to most likely live until they're 80-something.
If not 100.
Right? Who knows?
We're living
with
till
medical
100.
Technology, to your point earlier. And they're thinking of another 30, 35 years of life. And that next leg or legs of these journeys they're about to take. And they want to make sure, number one, they have the wherewithal to do whatever it is they want to do in that regard. And oh, by the way, have some fun. Because they are going to travel more. They are going to get more leisure time, but not 100%. So I think that the dynamic we saw last year was more the mindset of the baby boomer versus saying, my kids are going to squander it and they don't deserve it. But the other thing is, so I think they're thinking about that money in that context. What I worry about, though, and we see this again in the survey we did, what they're not thinking enough about are things like their own personal longevity. Right? They're not thinking, they are, but they're not. They're not really translating it in terms of what that now means in terms of the resources that they will chew up over those many years, hopefully for them. That's one. The other thing is they're not thinking about things like long-term care costs. We think that's the silent threat to family wealth. And what's interesting is...
People don't realize how expensive it is.
Oh my goodness. And it's not only their own, but increasingly the needs of parents, the needs of adult children.
You're the sandwich generation. You're taking care of your parents and you're taking care of your kids.
And in some cases, you're taking care of siblings who maybe weren't as successful as you. So you've got siblings, parents, adult children, maybe broken marriages, whatever's leading to it. So you've got all of those individuals in addition to your own issues from long-term care. And people are already today spending money to help parents, to help siblings, to help other adult children. And yet those same people, they're watching the movie begin to play. 2/3 of them have not built long-term care costs, either their own or their families, into their financial plans. So they're dramatically exposed. And I'm worried that that's indicative of a broader populace of wealthy out there who are still too narrowly focused on, am I getting that return I need to get, want to get, and not thinking about the bigger picture, which could be even more profoundly impactful. You think about it, I mean, long-term care costs versus another 50 or 100 basis points on an investment portfolio. And the other thing which is interesting too is that same group also, 72% did not have a comprehensive estate plan. And you think, how could these folks, they're smart, they're successful, they have wealth. Again, I think they don't think of their own mortality, number one, because again, it's the I'm going to live forever generation, so that's part of the problem. But 72%. And many of them are not using, as a result, tools like trusts. They're misunderstood, they're underutilized. And you say, well, why not? Two answers, which are kind of scary. One, procrastination. And in many cases, the people who are responding these aren't young people. I'm busy, I haven't gotten to it. And the second is a belief, which is even scarier, that their basic will take care of whatever it is they think they need to do.
Right.
And so there's a lot of disconnects out there. And I think it's reflective of individuals not thinking the right way, but also I think it's an implication of the advisors that they're using not having the right dialogue and the right conversation to say, Maria, we got to really sit down and talk about your estate plan, talk about long-term care costs, talk about the fact you're taking care of your parents already and it's going to get more costly as time goes on, and we need to build that in to protect you and make sure you have the wherewithal to do that and not wake up in 20 years and this nest egg you thought you had is no longer a nest egg.
So should we be earmarking one fund just for long-term care? I mean, I know there's one umbrella of retirement, obviously, and under that retirement umbrella, should we be having one fund that is just dedicated toward money earmarked for long-term care?
Well, I think what we need to be doing is making sure as we think about the uses of whatever the funds that you have, there are going to be draws on that perhaps you're not anticipating. And then the question is, is there long-term care insurance? So just be cognizant of it. Make sure people understand the magnitude of it or the potential magnitude. And then secondly, how do you plan, whether it's insurance, whether it's just making sure that a portion of that money is not going to be going toward whatever it is you thought it would, but in fact some very important things, which is the care of your family.
Let's get some questions from the audience for Keith. I think, yes, sir. Here we have a microphone coming to you.
There used to be the old adage that if the U.S. sneezed, the world got a cold. And it seems today that China might be in the same category. And there's been a lot of press about a potential looming debt crisis as a result of sort of the shadow banking, lack of good underwriting, et cetera. How do you incorporate that into your thinking about markets and the immediacy of that issue in terms of how you look at investing today?
Yeah, I mean, look, there's a lot of issues with China. When I think of China, I don't think of China today as an opportunity. I put it in the risk category. When you ask me, Keith, though, you think you're at the beginning of a secular bull market, you feel good about the economy here and globally, so what could go wrong? I'd give you three things. I'd say China. They don't grow 7, 7.5. They grow 3. I don't think that's going to be the outcome. I'd say Europe, that Europe just unravels because the ECB just doesn't do what they need to do. They keep twiddling around the edges, 25 basis points here. They have to do a massive, monetary stimulus program, just like we've done here in the U.S. They haven't done it yet, so that could get out of control and start to spiral down, which, oh, by the way, backs into China, because that's one of the biggest export markets for China. And the third thing, which is the unfortunate, ever-present geopolitical It's out there. We know it is, and if there were an unexpected, significant event. But China, look, the biggest issue with China, they've had decades of amazing growth. They've been written off over and over again. It is disconcerting that their credit to GDP is now around 210%, which if you look at other times in the US and Europe and other places, that's kind of a point at which things not so good began to happen. The biggest problem with China, it's how opaque it is. We can't really, the visibility into the US, the visibility to Europe, whether you like what you see or not, you can see it, you can feel it, you know what's going on. And China's got that, it's very opaque. So I think China is a risk, but don't forget, part of what people worry about now is that there's these empty buildings, empty towns, empty roads, and I think that's true to a large degree. But they need to move, I think the number, Maria, is something like 300 million people, into the cities.
Urban areas.
Yeah. And it's the equivalent of like a New York City, or whatever. It's crazy. The numbers are staggering.
Well, some of the cities are enormous cities, 10 million people.
Yeah.
But he brings up a really good point, and that is the debt ceiling debate, because
Right.
this dysfunction in Washington has unnerved the markets as well. Now, we do have another deadline coming up,
Right.
the end of the summer into the fall. We're probably going to see the two sides fight again over taxes, over revenue. Is that going to be an upset? The debt ceiling will likely be raised.
Right.
But getting there may be volatile.
Well, I think it'll reinforce the dysfunction that exists, and it's both parties, not one or the other, it's
Right.
both equally guilty. And there's no question in and they'll get it done, because they always do. But you have to go through this trauma before they actually do whatever it is they need to do. But then people get all wound up. It'll probably get the markets a little bit nervous. I don't think it'll be a big thing. But I will tell you, though, there's no doubt in our minds that we would be growing, forget the public side, even the private side, we would be growing at a faster rate. We would be seeing greater job creation than we even are today if some of this uncertainty would subside. If Washington could come together and address the issues that are out there in a constructive way, there's no doubt that has been a headwind for the economy in the U.S. And if they could ever get to the point of resolution, that could be another very positive thing. I think people have kind of gotten to the point of just assuming it's going to continue to be that way because it is that way. But if that were to change, I'd put that on the positive side of the ledgers as a tailwind, a headwind that could become a tailwind.
Do you think Europe, the euro, could go away? Europe, has it gotten better?
I'm not sure it's gotten a lot better. I think the headlines have subsided. So I think the press has kind of gotten...
It feels better.
It feels better. It's not gotten worse. But I think the problem is until you see, especially on the monetary side, I'd love for them to come in and do something similar to what Japan has just begun to do and is going to have a positive impact, what the U.S. has been doing. Think about the difference between the U.S. and Europe. Back in 2009, we were both at a 10% unemployment rate, 10% in the US, 10% in Europe. In 2011, Europe had a misstep. They started to tighten. And what happened was Europe's unemployment went from 10 to 12+%.
Wow.
And we went from 10 to 7.6. So not only did they not do what, a lot of people have been critical of Chairman Bernanke. I think he's done an exceptionally good job. And you can just compare and contrast because it's a good one with Europe. So I hope they will ultimately do what they need to do, especially on the monetary side. I think a banking union would be important, but it's a difficult situation. I don't think the euro will break. I think the countries there are committed to maintaining the euro, even if it means some countries may have to leave the union, but I think the euro is going to continue on.
That's certainly what they're saying.
Yeah.
More questions from the audience for Keith? Yes, sir. Right here.
Traditionally, when people get into their 70s and they stop having the amount of earned income that they were used to in their 50s and 60s, investment advice was, fixed income portfolios. You just said, forget it. That's not the good way to go. But the risk of an equity portfolio at that age might be something that's a little disconcerting. What are you telling your clients at that age to do?
Yeah, and let me be clear, we're not saying people should not have any fixed income. What we're worried about is people are overweight fixed income in an asset allocation context. So number one, we're particularly negative on treasuries. We think they are the most exposed because they got, in our minds, it was that flight to safety. Every time people got nervous, they go in and buy a lot of treasuries. So number one, I think the mix of fixed income is important. We would definitely not be encouraging clients to be in the treasuries. We still like corporates because, again, a lot of what I described from an economic standpoint, from a cash flow standpoint, means that the balance sheets of these companies are very strong, and so the fixed income instruments that are issued by these companies are good.
And there's some pretty good yield.
And there's some good yield. We still there's some great opportunities with sovereign bonds outside the U.S. High yield, again, you got to keep watching the spread, but that's been an area that we've liked. So we're in fixed income, and we still like munis, quite frankly. Munis, a lot of people got nervous about. There's some real scare stories early on, and about every muni going away and a bloodbath. It didn't happen. We don't think it will happen. You're going to continue to see pockets of some real bad activity, but it's not like you see that train coming down. So if you're doing your research, you know where those pockets of risk are, and you avoid it. So we still like munis. There's been a little pullback here, so there's, the yield is still attractive. So we sit down with our clients, depending on the situation. We will get some fixed income into the portfolio. We're very careful with the mix. We're very careful with the duration, because the longer the duration, the more volatile the price if rates do begin to go up. But what we're encouraging people, especially if it makes sense from a time frame standpoint, is to make sure that there's a full weighting in the equity area as well.
So for someone in their 70s, how much of the portfolio overall, and that's when you're looking at your real estate, your stocks, your fixed income, any other alternative investments, how much of some of these portfolios should be in stocks? I mean, and I know it differs depending on an individual and the risk appetite you have, but if you're in your 70s, what would be a rough?
You would be less than 50%. You would probably be maybe 30 to 40%. And again, a lot of it depends upon the risk tolerance of the individual. Someone just can't take, you start off with a great question about the volatility over just the last couple of weeks.
Right.
So if someone just can't take that volatility, then you got to be lower. If someone can take some volatility and think over the next 2 or 3 years, am I positioned well, then it makes sense to have some exposure on the equity side. If either the volatility doesn't work or there's just a need for more income in a more immediate sense, then we can try to find ways to get that as well.
I think that's a really important point. You've got to say to yourself, can I take this? If it's going to be up 200 and down 200 the next day. So how does that number change if you're in your 40s and 50s?
Well, the younger you are, the longer term your horizon is by definition, and the more you're going to be thinking about growth versus preservation. And so as what we find is, and again, you find some younger people who are still very risk averse as well, but typically the younger the client is, the greater exposure to equities, because the time horizon is longer. They tend to be more comfortable with volatility because, unlike the example given a moment ago, they still have current income. They're still progressing in careers, and the combination of all of it, they can say, look, talk to me about 10 years, 15 years, and position me, not that you don't tactically move it around, but position me to maximize the opportunity, because the growth of my wealth is an important objective for me. And there's still risk parameters around that, but it's going to be a very different risk parameter than someone in their 70s, by definition.
Makes a lot of sense. Yes, sir. Right here.
Presuming that Janet Yellen replaces Chairman Bernanke in January, what change in Fed policy do you foresee?
That's a great question.
Great question.
Because again, as I said, our firm and me personally have been big fans of Chairman Bernanke. I think he's been a great steward of the economy. My understanding, I don't know Janet Yellen well, but I've tried to read about her philosophy, her policies, and I think our takeaway is that you're going to see someone coming in who is very close philosophically to where Chairman Bernanke is. So we're not expecting, quite frankly, a lot of big changes or big philosophical shift. in how the Fed kind of views the economy and views the tools that they have to then influence the economy. So we think if she were to come in, it would be a good choice, and it would be one that would continue the good work that we think Chairman Bernanke and the Fed overall has been doing. So
That's what you want. You want a smooth transition.
Yeah, it's so important. I mean, it's so we think that would be a good outcome if there were a change.
Yes. Here it comes.
You talked about stocks, you talked about bonds, you talked about cash, but is there a role to play for hard assets in a portfolio today?
Yeah, it's an interesting question. We find that our clients really like hard assets. They love art, and art's been interesting because everyone thought the minute things got difficult, art was going to fall off the cliff, and it really maintains
It's held its value.
It really has, and more of our clients and just wealthy individuals and families, art is becoming something that they're very interested in and beginning to collect. They also enjoy real estate, but we have a group within U.S. Trust. It's called Specialty Asset Management, and we can go out and acquire farmland, timberland, oil and gas properties, not the funds, but actually go out and physically buy, and you'd just like when you buy stocks, a portfolio of ranches or a portfolio of timberland. And we have never had a bigger backlog. In fact, I just recently authorized hiring a number of additional people to support the pipeline that we've got. And the rationale is this: A, they just in general like hard assets, number one. Number two, and you made the point before, Maria, they were so shaken by the financial market that it just reinforced the proclivity toward the hard asset. But they also believe that with all of the quantitative easing we have seen, right move, if the economy both in the U.S. and globally does come out of this malaise that we've been kind of mired in, it will ultimately result in inflation. And there's no better hedge against inflation than a hard asset. And so, and they love the fact it's income producing. So it's just a win-win. So it's another area that we're seeing a lot of our clients and people outside of our firm really focused on and moving toward.
You know, I had not thought about agriculture in that regard, buying farmland. And about a year ago, I actually met Vince Vaughn, the actor. And we were talking about the markets. He was asking me about stocks. And he said, oh, no, I'm long farmland. I just was so taken aback. It didn't occur to me that this was so popular. And he was telling his Hollywood friends are all in farm. I mean, what is the rationale to own farmland? Is it China?
Well, farmland in particular is really interesting. So number one, there's an increasing scarcity of good farmland. Number one, so whenever
it's finite.
It's finite. A lot of farmland has been turned into condos. This next generation doesn't want to farm, right? So the minute I get the farm, I'm calling the real estate agent saying, all right, make me a bid. So farmland is shrinking, certainly in the U.S., but this gets back to this whole trend toward the emerging market middle class, right? Which is this powerful force of, if you think about all these emerging economies that we talked about earlier, as these economies grow, more and more jobs are being created, per capita incomes are going up, and which means more and more people are moving into that middle class status. The first thing they do when they get there, they want to nourish themselves like middle-class people all over the world do. And so if you think about whether it's China continuing to grow at the rate it's growing, all the people moving into the cities, but think of the emerging economies in general. Think of that. The numbers I've seen are staggering. I think there are like 2.4 billion as they define middle class right now globally. And that number is supposed to go to like 4.2 in the next 10 years.
That has huge implications.
Huge implications.
Particularly in Latin America, you're seeing that.
Absolutely right. So I think what people are seeing is there's this inexorable trend of greater and greater and greater demand for agricultural commodities to feed this growing middle class. That's going to be, and that's a good thing, right? That's a good thing for the world. So people are saying scarcity of property, incredible secular trend from a demand standpoint, and what's going to happen is you're going to see agricultural commodities reflect that in the prices, and if you own property that produces that, that's good stuff.
And in some cases, you've got that, not rent, but you've got regular income coming as
Correct.
well.
So what we do for our clients is we buy the property and we bring in operators, so they're not putting overalls on, getting out there and working the land, but they got a nice income stream coming in while they're just watching the acceleration of the value of the property. So it's and what a lot will do too, which is fun, they'll say, could you make sure there's a trout stream or a good hunting, and then you bring their buddies and you go, yeah, this is my property.
I love it. I
It's
love
all
it.
good.
Keith Banks, thanks very much. So interesting.
thank you.
Thanks, everyone.
Great fun time.